Hey everyone, hope they're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So we'll just dive right in there and take a look and see what is going on. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com. I dive deeper into all these sectors, topics, looking for potential investment opportunities. I convert these bigger picture views, these ratio charts of sectors and ETFs into individual companies. And those individual companies, for the most part, vastly outperform the ETFs. Some of those companies can go up many, many multiples, not like 3, 4, 5, 10x. They could go 30, 40, 50x, depending on how aggressive you want to get and depending on where you buy them. We still have the May Day coupon code that is active if you'd like to join our community and get exposed to those ideas. So, finding value myself, I says they say gold leads and oil follows. They both go up together in these bull markets. So I've got oil at the top here. You guys have seen that big long-term chart. I put gold priced in dollars. What is occurring here is the dollar is getting weaker. The dollar and the currency is driving these bull markets. One could argue that the credit expansion in relationship to oil supply is what drives inflation. But this is gold. Gold is sensitive to that credit expansion. Oil is too. Oil's the number one inflation sensitive commodity out there. You can see the consolidations and the breakouts, just the same thing as gold. Consolidation, breakout, consolidation, breakout, consolidation, and then we have recently a breakout. And I'm pretty sure oil is going to follow. It's just going to be delayed behind gold. So that is what they mean by gold leads, oil follows. They work under slightly different market conditions. Gold goes up during a slowdown in the market, which I think is occurring. And then it also goes up when liquidity comes back into the market. It reprices it all. So you get a slowdown, you get liquidity injections. Gold goes up first. And then when the yield curve or that slowdown kind of gets behind us, that money filters into the system and it filters its way into oil and other commodities. Now, oil goes in first because it's the number one commodity and it's used in the most amount of products in the market. So that's what we've got there. We've got another one: uranium futures prices. Stay bullish, my friends. That's what I say. As we were in the downtrend, you want to be bearish in these. As we bottomed and started to turn up, you can see that we've got big green candlesticks, small red candlesticks coming up. And we have downward facing patterns, like falling wedges. That is a bullish scenario. So what I did is I took positions in 2020, and I'm staying bullish the entire time. There are a lot of people that I see on Twitter, that I see even in the community a little bit. Their emotions swing greatly during this bull market, and it causes them to sell. It's called panic selling. My quote that I use is I panic buy. When people start to panic, I start to buy. So I'm a panic buyer. And I look for panic and fear. I look for poor sentiment, and I panic buy. That's how you make money. But I've been bullish ever since this line on the right-hand side. I didn't really follow it in 2018 or 2019. I got on board in 2020, specifically in the summer and fall. I was researching my uranium companies at that time to really uh, put big stakes into those companies. I've been bullish the entire time. There's no reason for me to be bearish here, and I should continue to ride this thing to the upside. And if you need help, if you need help calming those emotions, join our community. I talk a lot about this during question and answer sessions. I also show you when I'm bullish on these particular companies, sometimes it works out very well. I'd say most of the time it works out very well. XAU, which is the gold and silver miners versus gold ratio. I say it's cheap and gold is moving higher. Prepare yourself. What does that mean? Well, this is XAU. This is the gold and silver mining companies divided by gold. What I look for is a cheap setup for the mining companies or the equities. And I want to see that gold or the commodity itself is going up. It is going up, and we've got a cup and handle that's recently broken out to the upside. What does this mean? It means that we are coming from very low valuation levels in gold and silver mining companies. It means that they can revalue a whole crap ton against gold itself. Now, some people will ask, well, how come the gold and silver mining companies aren't going up immediately? Shouldn't they be going up immediately with the price of gold? Well, there's certain things that people may not believe in the market. In the beginning phases, a lot of people are in disbelief. It's part of the psychology of humans. And when you think about it, you go, okay, well, people aren't believing the move. So what do you think? They're not going to believe that the gold and silver mining companies are ever going to go in a bull market again. That is what you need to take advantage of. I've already entered my positions in a lot of these with size. So what does that mean? It means that I purchased when the sentiment was worst. Even in our own community, people did not like, even though they were very receptive to commodities, they didn't believe that the gold and silver mining companies were going to go anywhere. They were still in disbelief. The the psychology is rooted so deeply in everyone. And once you become aware of it, once you can see it for what it is, that is when you can become a great investor. Because you can just walk around and see it. Oh yeah, silver mining. I've lost my butt in silver miners. But then when the market conditions change and they come into favor, they don't want to buy it because of those past experiences. I kind of throw that to the side and say I need some allocation to this, just for the fact that you've got a massive cup and handle here that is breaking on gold. Our leader is breaking. We should have been buying, which we were, silver companies on this breakout here because silver follows gold. So are you taking advantage of these leaders? Are you following with the companies or commodities that follow in the sector? That is what makes the difference between an okay average investor versus a great investor. And then you've got people who are really bad investors that just chase price. I mean, that's part of human nature as well. Now here's an update on URA, and I just have a plane going, and we've broken. Look at the line going across here. That's where it closed. We are above, our closing price is above the highs here. We could very well rip in uranium. And all you had to do was buy in these corners here and just sit and do nothing. Now, I bought back here in 2020. I bought again in this corner here quite a bit. I bought a couple times in the middle over here. And then I haven't really bought much since then. But there are still opportunities in uranium if you look at the companies that no one is looking at. That is my hint. When no one's looking, you just ninja buy, guys. Ninja buy. What is a ninja buy? A ninja buy is when you get in there, no one knows what the heck you're doing. They have no idea what sector you're even looking at, and you just steal shares. You just steal shares down there. You've got the Kathy Woods, you've got all these people, maybe it's Michael Saylor, whatever. They're going to be blabbing Bitcoin outperforms everything. Kathy Woods talking about whale oil, and the oil, that regular oil is going to become whale oil, which, I don't know what the heck she's smoking. All these people are they're just all blabbing, blah, 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 blah. And you're over there ninja buying stuff. You're like getting in there, nobody knows what you're getting. You're buying stuff when no one's looking, and you just steal the shares, guys. You steal the shares from the market. And then you simulate a portfolio when all of the sentiment is bad against those sectors. I have a lot of people, what's your percentage allocation to oil? What's your percentage allocation to uranium? I don't operate like that, guys. I buy what's cheap. If someone said, "I'll give you a Ferrari in perfect condition for $20,000," I'm not going to say no. I'm not going to buy it. I'm going to figure out a way to buy it, and then I'm going to go sell it again in a different market condition when it's better conditions, and go sell it for maybe a few $100,000. The opportunities are what dictates my percent allocation to my portfolio. It's not a percent here, percent there, percent there. Like, I don't operate like that. I never have. It doesn't make sense to me. So someone might ask, well, then the opportunities, if you have more money when something is down versus another sector, then your allocation will be bigger. I'll be like, yep. If the risk reward in the company is great and the opportunity is there, I jump on it. I'm not going to be like, well, I hit my 4% allocation. I'm just gonna, put it to something else. Now, in individual companies, it's different. You're gonna have allocation sizing that's gonna limit risk, but I'm talking about sectors and when to buy certain sectors. So my portfolio fluctuates dramatically in terms of its percent in whatever position, like percentage in uranium, percentage in oil, percentage in gold and silver, and whatever's down and has the best risk reward and probability of success, I hit those up. David Murrin says the next commodity surge has commenced. We believe that the commodity sector is now at the start of one of the biggest rallies in 56 years, with an expected peak in 2025 to 2027, as recently explained. So commodities, in his opinion, are about to surge here, or are surging, depending on what you're looking at. Metals weekly price performance, we've got silver up about 4.66%. Platinum is up. Our boy Platy, gotta put that in there. We've got gold at all-time high, 2%. Palladium. So these are all precious metals here. Precious metals they did very well last week. At the bottom end, the base metals coming up with the tail end of losing. Nickel, tin, copper, zinc, and lithium, all down about 2% or more. In the middle, aluminum, uranium, molybdenum, not doing too much. Formore says, reminder, the gold to silver ratio through history via the Silver Manifesto. David Morgan and Chris Marchese. So here's gold silver ratios versus history. 2.5, which means gold was only 2.5 times the price of silver. And then you can see it ranges about all the way up to about 15. And that's going from 3200 BC all the way to the 1700s. So in that time frame, the gold to silver ratio never exceeded 15, and it never went below 2.5. Now, we could look and let's just say that industrial demand for silver goes way up. What is the alternative for silver? Is it gold? So, I mean, I think we could see silver go up dramatically. What we've been doing recently is we've been riding on the cost curves of silver. So whenever silver's produced at, we've been riding on those cost curves the entire time almost. There are a few times in history where we go up to demand destruction, and it's mainly demand destruction of investors. If we get a large surge in silver demand, which we've been running deficits in silver. We could see the ratio against gold dramatically decline in favor of silver. We could even get to these levels again eventually. Will it get there immediately? I don't know, but I do think that we could possible get down there and above ground silver to gold. I think it's probably 1 to 2.5, 4 times, something like that. Is what 1 ounce of gold and only 4 ounces of silver above ground in investable format. Maybe that is an ultimate bottom. I don't know. That's kind of where it's at that ratio. S&P 500 to gold ratio. We've got the Federal Reserve going into power of 1913, and then we see these dramatic swings in the S&P 500 divided by gold ratio. And we've got this kind of rising wedge going on that we could potentially roll over and go down again. Much like history, we can see all these big moves lower from the 1929 peak. From this is here, the 1960s peak, and then in 2000 peak and all the way down. And I think we could potentially head lower again. And maybe we hit something like 0.5 on this ratio. Very possible. Gold to oil ratio and oil to gold ratio, just showing you guys, the shoulder head shoulder bottoming pattern that we're getting in crude. This is gold to crude oil, which means crude oil would outperform in the future. A lot of people aren't thinking like that. Remember, leads, gold leads, oil follows. Oil follows. Gold leads, oil follows. Gold leads, oil follows, and gold leads. We're back to that peak about, and we'll probably see oil following. If you price it in the other direction, crude oil versus gold, I've got expensive oil at the top, very cheap oil on the bottom here. We are at a very cheap level. In fact, this level here is unheard of. That's an anomaly in history. So at a very low level, is this a false breakdown where we eventually slingshot to the upside in oil? Don't know yet. We'll find out. I kind of think it will be, but that's just an opinion. It's not a fact. Palladium to silver ratio and palladium to gold ratio. So let's look at palladium. A lot of people kind of forget about palladium. Buy silver is when silver kind of rockets up into this level up here for the ratio. And then we have fallen all the way down to the buy palladium at the bottom here. So buying palladium down here was very long, I would say, hold period. But we rocketed higher here in the 1990s, 2000, came back down. Another great buying opportunity in 2009 and 2011. Came all the way back up. Big buying opportunity for silver in 2020. And we've come all the way back down. I still think we're going to go lower here and probably bottom at ratios maybe back in here. Could be 1 to 15 or something like that. This is buy gold versus buy palladium. So gold's up at the top, and then we've got palladium at the bottom. You can see that we are very low for palladium still. But that doesn't mean that we're at the absolute bottom. It just means that we are getting cheap. That's all it means. But we could still fall lower based off the market conditions. The market conditions are worries about a slowdown, or maybe there's more gold buying with some of these central banks. And in the short term, we could very well push this a little bit lower. It's possible. I'm just stating that it's getting cheap. Gold to silver ratio, I've got this. I've got this kind of, I drew this way. Kind of looks like a 3-hump consolidation. And then we came down into a slingshot in 2011 where gold outperformed silver all the way to the bottom of 2020. And now we're starting to come back. This to me looks like an inverted flag pattern or something that will eventually break to the downside. So silver will probably outperform gold here at some point, is what I see. JC says sector rotation is the lifeblood of the bull market. You don't have to like it. This is just the way it works. So this is technology underperforming here, -3%. We've got utilities doing well, and I think that deals with the demand for electricity, AI, all of that stuff going on. I also think that there's tailwinds based off of the inverted yield curve uninverting. We've got the real estate area also doing quite well. We are in an expansion phase of real estate, and this is part of that. We've got industrials behind it, financials. Financials generally do well when real estate does well. They go together. Materials are doing well. Energy is a laggard here out of these. Easiest ways to make money, according to Mango, men's lust. I will say this, guys. I'm getting a lot of crap on Twitter, and there's like chicks on there all the time now. It used to not be like that, but now it's getting worse. It's almost like porn site to some extent. Women's desire for beauty, so they want to look beautiful. Elderly's health, children's education, rich people's fear of loss. That's what YouTube has been hitting up. It is people losing money in stocks. They talk about the real estate, market bubbles, all of that stuff, and brokies' desire to get rich quickly. So that's what you see if you go through and you look at all of these ads and people on YouTube. Generally see those, and those are the things that they focus on to get you. It's those topics. U.S. budget deficit jumps to 6.3% of GDP in quarter three, up from 5.6% in quarter two, and the highest in 2024. This is the crisis deficit spending, which normally corresponds to 7.2% unemployment rate. But in this case, it is meant to put lipstick on the economy in an election year, what they're saying there. Trying to slow that slowdown. Tony says, careful out there, coiners. Yes, Bitcoin looks great. That is now the consensus. Take the S&P and bid it, amigos. So S&P is the lowest. We've got gold and silver. And Bitcoin is by far the choice for outperformance from now till the end of the year. That's where everybody is bullish. Well, he's taken the contrarian approach and says, maybe the S&P 500 will outperform the rest. Gold's probable path. We've got a line coming up here at the top. Connection, and then all the way up. You know what's uncanny here? There's a lot of companies that I follow. You put it on logarithmic like this, and they have the same pattern when you connect it from the 2000s like this, from peak, and it goes all the way up. And we also have a line, and some of the oil companies are just below this breakout of this line here. They're like just underneath it here, and they're flagging out. If they go all the way up here, oh my God. I mean, I would be well over 100 bagger on a lot of the companies that I hold if they were to go to that level, the way that he has this drawn here. If gold does this, what that means is that the dollar is eating it. It also means that oil is going to follow. So gold leads, oil follows, and I do think that we will eventually get up to those levels. It's not, you shouldn't focus on supply and demand necessarily. It is credit driven. It is the denominator, the value of the dollar is going to get hit, and that's what's going to drive all this. So if I bring this up to people, they'll say, well, the Middle East, they'll start talking about supply and demand. It's like, guys, got to look at the currency. The currency units, gold went up, not because of the supply and demand of gold necessarily, and there is a factor to it, but it's the dollar. And then what happens is it forces investors to move differently in the market. Money rotates differently in that type of environment and market condition. So it's not supply and demand of all of commodities all go up at the same time. It's the currency units shifting in the market. It's the market conditions. Any wisdom, it says one of the simplest ways to lower your income taxes is make the maximum contribution to your employer's retirement plan. Save in taxes, build more retirement, a double win. It depends how much money you make. That may be a good option. It may not be a good option. There are people who might make 100 and some thousand, they're married, and they have kids, and it may be better to put some of your money in a Roth 401k and pay taxes up front because you have deductions, and you're not really paying a lot of tax. It also depends on how much money you have saved up and you can generate returns from. If you start early and it starts to really build, it's good to have some of your money in tax free accounts like Roth IRAs, Roth 401ks. So I do a combination, and it really depends on how much money you make today and what the amount of tax you are saving. If you're saving like 30 something percent, then yeah, that's great. But if you're saving and you're at the lower end where you take all your deductions out and everything and you're really not paying that much, it's kind of like, well, you could put it in a Roth 401k and you might be better off. If you expect to make even more money in the future and you've amassed, we'll say, a decent amount in some of these accounts where it starts to compound quite dramatically. So I do a little bit of both. A great company keeps working when you're not. It will eventually earn more and more and more while you're just sitting and doing nothing. And a mediocre company won't do that. So you're harnessing a long range force that will help you. It's very important, says Charlie Munger. So pick great companies that can compound over time. They can do that with you sitting there and doing nothing. The ultimate lazy man's way to get rich, isn't it? Critical minerals for U.S. needs China for. I don't know if that's well written, but yttrium, rare earths, bismuth, antimony, arsenic, germanium, gallium, barite, graphite, natural graphite, and tungsten. That's what we need China for those minerals. Silver miners, time to play catch up. We've got a 14-year base. You can draw a line through here too that squeezes into this corner here. Breakout, and this came back. This is a great time to do a false breakout buy there. Then we're going to be heading higher here. We've got a bullish divergence on the relative strength indicator, according to rock bottom entries. And that's what we've got for today, guys. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel, subscribe to the website, and we'll catch you next time. This is Finding Value.